So coming to the next standard, IAS 36, impairment of the assets. So generally, what is meant by an impairment? So impairment is nothing but what the sudden decrease in the value of an asset. The sudden decrease in the value of an asset. So generally, as per the conservatism rule, asset should be recorded in the books of account to the extent of the recoverable amount. If the asset is shown in the books of account more than the recoverable amount, then we need to bring that carrying amount to the recoverable amount. Then that reduction in the carrying amount is technically called as what? Impairment. That is called as what? Impairment. So in this standard, we are going to discuss so how to calculate the impairment loss. And the standard is not applied for so valuation of inventories. The standard is not applied for valuation of inventory. So the standard is not applied for inventory. So and construction contract and deferred tax assets arising from the employee benefits, and financial assets included in the scope of IFRS 9, and investment property and the non-current assets held for sale. So for these items, so these elements, IAS 36 is not applied and impairment is not considered. And it applies to land, and building and plant and machinery, and investment property held at the cost. So if you remember, investment property initially recognized at cost, but subsequently there are two models are there, either at cost model or at the fair value model as per IAS 40. If you follow the fair value model, then for that investment property, IAS 36 not applied. If you follow the cost model, for that investment property, IAS 36 is applied, because if you follow the cost model and the accounting is done as per IAS 60. So just like property, plant and equipment. Next, intangible assets. And it applies to goodwill. And investments in a subsidiary company, associates, and the joint, those which are carried at cost. So, and those assets which are covered in which are revalued as per IAS stream. So these are all covered in the IAS 36. IAS 36 applies to these all type of the assets. So here, what is meant by impairment is provided. So impairment is asset is impaired if its recoverable amount is less than the value currently shown on the statement of financial position. Okay, so what is that mean? For example, if the carrying amount is less than the recoverable amount, there is no impairment. If the carrying amount is more than the recoverable amount, then there is a indication of what? Impairment. There is an indication of what? Impairment. So here, impairment loss is equal to carrying amount minus recoverable amount. Carrying amount minus recoverable amount. Then how to calculate the recoverable amount? Recoverable amount is calculated as higher of value used or net realizable value. Value in use or net realizable value. Net realizable value stands for fair value of the respected asset less cost to set. Fair value of the respected assets less cost to sell. So the higher of value in use and fair value of asset less cost to sell. Here, what is meant by fair value? The fair value is nothing but the present value of benefits received. The present value of cash flows associated with that asset is said to be about value in use. Is said to be about value in use. So to calculate the impairment of the asset, we have to know these two elements. So one is carrying amount and another one is what? Recoverable amount. So then how to calculate recoverable amount? Recoverable amount is calculated as higher of value in use or fair value less cost to sell. Fair value less cost to sell. And then that is what is meant by an impairment. What is meant by an impairment? Then here, how to calculate the NRV? So net realizable value. Net realizable value. So the net realizable value is the calculation. In case of net realizable value, we have to measure what? Fair value. We have to measure what? Fair value and cost to sell. So the measurement may be by way of binding the sale agreement or contract current market price less cost of disposal. If the active market is available. If the active market is available. For example, in the absence of the sale agreement, then based on the active market, we calculate what is the fair value less cost to sell. That is considered. And value in use means the present value, the estimating the future cash inflows and outflows to be derived from the use of that asset and its ultimate disposal, applying the suitable discount rate to these cash flows. And simply we define as what present value of the cash flows generated by using that asset is said to be a what value in use. Those are said to be a what value in use. And first of all, so how to verify whether impairment is in existence or not? So the existence of an impairment, those are called as indications of an impairment. There are two ways out there. One is internal sources and another one is external sources. One is what? Internal sources, another one is external sources. So internal sources like obsolescence or damage of the property or damage of the respected as a physical damage of the respected asset, or if the asset is idle, if the asset is idle and worse economic performance of the asset, the performance of the asset is not up to the mark. Worse economic performance and if the fair value of the investment is more than carrying amount of the investment in subsidiary company, associate and joint venture in the books of accounts. The fair value is more than the carrying amount. So these are all considered as what internal sources. Then coming to the external sources, so market value decreases. So decrease in the market value and negative changes in technology and market economy or laws or legal or what legal fluctuations, legal changes, so regulatory changes and increase in increase in interest rates, and the last one is net assets, net assets of the company, net assets of the company is more than market capitalization. Net assets of the company is more than market capitalization. And these are all considered as indications for existence of an impairment. Indications for existence of an impairment. And so there may be, in some cases, we need to reverse that impairment loss. We need to reverse that impairment loss. So what are the indications for reversal? So Volta conditions are considered. For example, increase in interest rate leads to indication, it is an indication for existence of an impairment. But decrease in interest rates is an reversal, indication for reversal of the impairment. And net assets of the company is more than market capitalization, Volta, and market values are increases, and there is a positive changes in the market or legal fluctuations. These are all what so indications for reversal of the impairment. But the reversal of the impairment is done only if the impairment already made in previous periods. Already made in previous periods. Okay. So coming to here problem. So here carrying amount, so three assets are there, A, B, C. Carrying amount, first coming to A, carrying amount and NRV value in use. So among the net realizable value and value in use, whichever is higher, 120, that 120 is said to be recoverable amount. Carrying amount is a less than, carrying amount is a less than recoverable amount. Carrying amount is a less than recoverable amount. So there is no existence of impairment. So impairment loss is none. Then coming to the second case. So NRV or value in use, whichever is higher. So 130. 130, that is the recoverable amount. Carrying amount 150. So carrying amount is more than the recoverable amount. So there is an existence of the impairment. So what is the impairment loss here? 20,000. And here, so net realizable value or value whichever is higher. So 100. This is the recoverable amount. So carrying amount is more than recoverable amount. So that 20,000 is said to be what indication impairment loss. So these are the indicators for impairment. So that requires at each reporting date, an entity must assess whether there is an indications of impairment. Indications may be derived within entity itself or called as internal sources, outside called as external. Assets market value has declined more than expected, and changes in technology market or legal fluctuations, interest rates are increased, etc. So these are all called as what external indications. And coming to the internal, there is an evidence of obsolescence or damage, and change in the way of asset use have occurred, or means the uses of an asset is altered. It may also lead to what decrease in sudden decrease in of an asset. Evidence available from the internal reporting indicating that economic performance of the asset is worse than the expected. These are all called internal sources. Next, annual impairment review. So where there is no indication for impairment, then no further action be taken. So generally impairment loss is considered when there is an indication for existence of an impairment, either internal sources or by using external sources. But in some cases, we have to consider impairment. That is an exception. So the goodwill acquired in the business combination, and because these are all arised because of the contractual obligations, and an intangible asset with an identified with indefinite useful life, intangible asset not yet available for use, not yet available for use. In these three cases, these are the three cases which are exception for considering the annual impairment review. IAS 36 require annual impairment review for these assets irrespective of whether there is an indication for an impairment or not. So in these three cases, we have to consider the impairment at the end of the every year. Then coming to the next one, so recognition and the measurement of the impairment. First of all, so how to calculate the impairment? Impairment loss. Impairment loss is equal to carrying amount plus minus recoverable amount. Then what is the journal entry for impairment? So debit impairment loss, credit property, plant and equipment, or that corresponding asset account. corresponding asset account. So here the recoverable amount should be calculated first. Asset should be written down to recoverable amount. The impairment loss is immediately recognized in statement of profit and loss. So first we have to write this entry, debit impairment loss. Then we have to transfer that impairment. Debit statement of profit and loss, credit impairment loss account. The only exception if the impairment reverses a previous gain taken to the revaluation surplus. So then what is that meaning? For example, some property, plant and equipment is there and its cost is around 10 lakhs, around 10 lakhs. And so here some revaluation happened. Fair value of the asset 12,50,000. Then, so here in case of the balance sheet, how to show under PPE, we show 12,50,000 and under equity revaluation surplus, we create 2,50,000. Then its useful life is, for example, 10 years more, and further 10 years are there. Then depreciation required to create, so 12,50,000 by 10. So 1,25,000 is the amount of depreciation. So at the end of the year, first year ended, after revaluation, first year ended, we create the depreciation. So PPE is so 12,50,000 minus 1,25,000 equal to 11,25,000 and the equity revaluation surplus 2,50,000. Just assume that the depreciation completely transferred to P&L without adjusted to the revaluation surplus. Then at the end of the first year, some impairment test was conducted. So here the carrying amount is equal to at the end of the first year how much? 11,25,000 and the recoverable amount is calculated as 10 lakh. Recoverable amount is calculated as 10 lakh. So there is an existence of an impairment. So impairment loss is equal to how much? So the difference amount of 1,25,000. Generally, what is the journal entry we discussed? Debit impairment loss, credit asset account. So asset is shown at 10 lakh. Then second one, that impairment loss is transferred to P&L. Debit statement of profit and loss, credit impairment loss. But here that impairment loss is not transferred to P&L. We have to transfer that impairment loss to the revaluation surplus. After adjusting the revaluation surplus, if any more impairment loss is required, that will be transferred to P&L. What is the journal entry required to be recorded? So debit revaluation surplus, credit impairment loss. So 1,25,000. For example, if impairment loss is around 3 lakh, impairment loss is around 3 lakh. Then, but in the evaluation surplus, we have only 2,50,000. Then the 2,50,000 adjusted to revaluation surplus and the difference amount taken from the profit and loss. Profit and loss. So that was clearly stated. In this case, the impairment will be taken first to revaluation surplus. So until the revaluation gain is fully exhausted or adjusted, then any excess is taken to the statement of profit and loss. Taken to the statement of profit and loss. So in case of revaluation happened previously, we have to write this entry. So what is the entry? Debit revaluation surplus, debit statement of profit and loss, credit impairment loss. First, we have to give the adjustment to revaluation surplus. Later, we give the adjustment to statement of profit and loss. If any required additional amount is there, that will be transferred to statement of profit and loss. Then here. So an entity owns a car that was involved in an accident at the end. It is barely usable, so the value in use estimated 1,000. And however, the car is classic and there is a demand for the parts. This results in a fair value less cost to sell 3,000. The opening carrying amount is 8,000 and the car is estimated to have a life of 8 years from the start of the year. The car identify the recoverable amount of the car and any impairment required. So first of all, what is the recoverable amount? Higher of the net realizable value or value in use. Value in use was given as 1,000. NRV is provided as 3,000. 1,000 or 3,000, whichever is higher, 3,000 is the recoverable amount. And what is the carrying amount here? So carrying amount is equal to 8,000. So carrying amount equal to 8,000. But this carrying amount is the opening carrying amount. Opening carrying amount. So 8 more years there. So 8,000 by 8. 8,000 by 8. So 1,000. So if you reduce the 1,000, then what is the closing carrying amount? Our closing book value 7,000. And this closing book value is required to be compared with the recoverable amount. So here closing carrying amount is more than recoverable amount. By how much? 4,000. That 4,000 is created as what? Impairment loss. Impairment loss. Then what is the journal entry? So debit impairment loss credit or account. So how much? 4,000. Next, debit statement of profit and loss credit impairment loss 4,000. Okay. Next, an entity owns a property which was revalued to 5 lakh on 31st March 2000 X3 with the revaluation gain 2 lakh being recognized as other comprehensive income and recorded in revaluation surplus. At the 31st March 2000 X, the property had a carrying amount of 4 lakh 60, but the recoverable amount is 2 lakh. Then here on 31st March 2000 X5, the carrying amount is equal to 4,60,000 and the recoverable amount is equal to 2 lakh. So carrying amount is more than recoverable amount. So impairment loss is recognized as 2,60,000. This 2,60,000 first adjusted to what? Revaluation surplus, which was already created previously. How much created? 2 lakh. But impairment loss required to be adjusted 2,60,000. So we need 60,000. That 60,000 transferred to statement of profit and loss 60,000. Then what is the journal entry required to record here? Debit revaluation surplus, debit statement of profit and loss, credit impairment loss. So 2,60,000. Okay. Next, reversal of the impairment. So to calculation of impairment loss is based on the prediction of so what may happen in the future. Sometimes the actual events turn out to be better than predicted. So like increase in interest rate. So for example, in future the interest rates may be decreased. Then that is the case for reversal of the impairment loss, and the asset will perform more better than the expected. That is an indication for reversal of the impairment loss. So if this happens, the recoverable amount is recalculated and the previous written down is reversed. So remember, the previous written down is reversed, meaning the reversal of the impairment loss is possible only if impairment loss is recognized in the previous period. For example, previously there is no impairment test conducted, then at the present reversal is not possible. So impaired assets should be reviewed at each reporting date to see whether there is an indication that impairment has reversed. A reversal of impairment loss is recognized immediately as a income in the profit and loss. Then how to recognize? So debit, so impairment loss, credit statement of the profit and loss. So this is the journal entry. For example, in case if it was adjusted to the revaluation surplus, we write debit impairment loss, credit revaluation surplus account. So revaluation surplus. So and credited to revaluation surplus. The reversal must not take the value of an asset above its depreciated historical cost. The reversal must not take the value of an asset above its depreciated historical cost. Depreciated historical cost. So what is that meaning? For example, For example, cost of the asset 10 lakh and its useful life is 10 years, and we provide the depreciation for 3 years, 3 lakh. Book value at the end of the third year, 7 lakh. And book value is nothing but what carrying amount. Recoverable amount on that date is 5 lakh. So impairment loss is 2 lakh. So for the fourth year, carrying amount is nothing but how much? 5 lakh. Recoverable amount will be revised over the remaining useful life. So out of the 10 years, 3 years completed, remaining 7 years are there. So 5 lakh by 7, how much? 71,429. So depreciation 71,429, and we provide the depreciation for 2 years. So then carrying amount 5 lakh. So less the depreciation for 2 years. So 71,429 into 2. So 1,42,857. 1,42,857. Then what is the book value of an asset? So 3,57,000. So 143 is the book value. So for example, in the current year, after means fourth and fifth, at the end of the fifth year, so we came to know that the interest rates are decreased and the asset is performed very well. So we calculate the recoverable amount. The recoverable amount is calculated as a 4,50,000. 4,50,000. So here the carrying amount is 3,57,143. Recoverable amount is 4,50,000. How much amount required to be reversed? The difference amount required to be reversed. That is wrong. So in case of reversal of impairment loss, first calculate if impairment loss is not happened, then what is the book value on that day? So if impairment loss not happened, what is the book value? So cost is equal to 10 lakh. So how many years we provided? Fourth and fifth. Total 5 years we provide the depreciation. So depreciation is equal to 5 lakh. Then what is the book value of an asset? 5 lakh at the end of the fifth year. Then due to the reversal of impairment loss, so how much amount required to be reversed? So 4,50,000 minus 3,57,143. 143, nothing but what? 92,857. 92,857, this amount. So but here what is the difference amount? What is the difference amount of? So this is the difference between 92,857 is the difference between carrying amount and recoverable amount. But what is the maximum reversal of the impairment loss? Maximum amount is nothing but the difference between book value of the asset. If book value of the asset, if impairment loss is not happened, and the recoverable amount. 5 lakh minus 4,50,000. 50,000 is the maximum amount of the reversal of the impairment loss. Maximum amount of the reversal of the impairment loss. Clear? So if in case of reversal of the impairment loss, first you need to calculate only one thing. If the impairment is assume impairment is not happened, then calculate what is the book value at the present. Then the difference between book value and the recoverable amount is the maximum amount can be reversed. Then the reversal amount is compared with the difference amount, and maximum can be reversed is nothing but to the extent of difference amount of 50. So here the difference here impairment loss reversed is 92,857, but maximum the difference amount between book value and recoverable amount 50. So the amount required to be reversed is equal to 50,000. Next, an impairment loss recognized for goodwill cannot be reversed in subsequent period. Reason for this that once the purchased goodwill has become impaired, any subsequent increase in its recoverable amount is likely to be an increase in internally generated goodwill rather than the reversal of impairment loss recognized in original goodwill. Okay. Then these are the indications for reversal of the impairment loss. Then here, so Boxer purchased a non-current asset on 1st January 2000 X1 at a cost of 30,000. At that date, the asset estimated useful life is 10 years. So depreciation is 3,000 per year. So depreciation equal to 30,000 by 10, 3,000 per annum. Boxer does not reveal this type of asset but account for it on the basis of depreciated historical cost at 31st December 2000 X2, subjected to impairment review and add a recoverable amount of 16,000. At 31st December 2000 X5, circumstances which cause original impairment to be recognized have reversed and no longer applicable with the result of recoverable amount of 40,000. Result of recoverable amount of 40,000. So on what date? 31st December 2000 expire. Then first calculate the book value on that day if impairment is not happened. So generally what is the original cost? 30,000. So just assume that no impairment is happened in subsequent period. Then from the 1st January 2000 X1 to 31st December 2000 expire, how many years are there? So January, so X1, X2, X3, X4, X5, 5 years. 5 into 3, 15,000. So book value of the asset if depreciation, if impairment is not happened is 15,000. Then next, calculate what is the impairment loss considered previously. So first impairment done on what date? For 31st December 2000 extra. Nothing but first 2 years depreciation is provided. So 30,000, 2 years. 3,000 into 2, 6,000. Then what is the book value? 24,000. But this is the book value, but the recoverable amount is 16,000. Then so impairment loss is 8,000. Impairment loss is 8,000. So then from the second year onwards, what is the book value of an asset? 16,000. Nothing but recoverable amount. So 16,000 by how many remaining useful life? 2 years completed out of 10 years. 8 years are there. So from that, we need to provide the depreciation till 31st December 2000 X5. Nothing but X3, X4, X5. 3 years we need to provide. So 3 by 8. 16,000 by 8 is equal to 2,000. So 2,000 into 3 years we need to provide, right? From 31st December 2000 X2 to 31st December 2000 X5. We need to provide 3 years depreciation. Nothing but 6,000. Then what is the book value? Carrying amount is equal to 10,000. And on that day, the recoverable amount is recalculated as how much? So 40,000. So recoverable amount is recalculated as how much? 40,000. So there is an indication for reversal of impairment. But so how much amount required to be reversed? So actually previously we consider impairment loss of 8,000. Then the question is whether 8,000 completely reversed or not. No. So how much amount required to be reversed? The amount required to be reversed is nothing but what is the book value if impairment is not happened. Already we calculated as 15,000. And what is the book value on the date of reversal of the impairment? 10,000 and the difference amount of 5,000. This is the maximum amount of impairment loss reversed. Impairment loss required to be reversed, not this 8,000. This 5,000 will be reversed. Then we have to write the journal entry, debit impairment loss, debit impairment loss, credit statement of profit and loss account. So this is the amount of impairment loss, not the 8,000. Not the 8,000. And next one is cash generating unit. So first of all, what is meant by cash generating unit? So cash generating unit is nothing but, so it is the smallest identifiable group of assets that generate cash inflow that are largely independent of cash flows from the other assets or group of assets. So cash generating unit is nothing but it is a group of assets. First, generally, we if possible, calculate recoverable amount for the each and every asset individually. If it is not possible to calculate the recoverable amount for individual asset, then calculate it for the group of asset, and that group of asset is called as what? Cash generating units. And the value in use calculated may be impossible on single asset because the individual asset does not generate any distinguishable cash flows. In case impairment calculation should be based on what? Group of asset, that is called as what? Cash generating unit. But in case of impairment calculation, first we calculate what is the cash generating unit, and compare the carrying amount with the recoverable amount. The difference amount is treated as a impairment loss. But that impairment loss first is allotted to the purchased goodwill. First is allotted to purchased goodwill, and then to the other assets, including intangible asset, cash generating unit. On what basis? Pro rata basis, based on carrying amount of each asset in CGU. But it does not provide it to the other assets if it is not identifiable. If it is not identifiable, say clearly stated, no individual asset should be written down below its recoverable amount. That means unless specifically impaired, current assets are unlikely to be impaired as a part of CGU, as they are already likely to be carried at the recoverable amount. Inventory, as noted above, is outside the scope of IAS 36. So if any current assets are there, those are not considered. So here, so in this case, so SEPCO runs a unit that suffers a massive drop in income due to the failure of its technology on 1st January 2008. The following carrying amounts were recorded in the books immediately prior to the impairment: goodwill, technology, brand, building, other net assets. Recoverable amount is 85,000. So recoverable amount is 85. Then what is the carrying amount of the total? 20 plus 5 plus 10 plus 50, 30, 40, 155 is the carrying amount. So carrying amount is equal to 155. So recoverable amount is equal to 85. Then what is the impairment loss? 70. So what is the impairment loss? 70, correct? Yeah. So the technology is worthless. The technology is worthless. So that $5 million is not considered. So impairment loss is recognized only 65,000. And the other assets included inventory and so receivables. So inventory and receivables are not liable for impairment. It is considered that carrying amount of other net assets is reasonably represented of their net realizable value. What is the impact of impairment? The 65,000. The 65,000 first allotted to goodwill. Goodwill 20. Goodwill 20. And the remaining how much amount is there? 45,000. And that 45,000 is allotted to the remaining so brand, land, and the building. In what ratio? 10 is to 50 is to 30. Nothing but 1 is to 5 is to 3. 1 is to 5 is to 3. Okay. In that way we have to allow. So out of the 65, goodwill 20. That remaining 45 is allotted to the others. So building, sorry, brand, land, building. In what ratio? 1 is to 5 is to 3. Nothing but 8. So in that ratio, we have to allot the impairment to the individual asset. So this is what impairment loss. Okay. 65 is allotted. 65 first to the goodwill. Then remaining in what ratio? So 1 is to 3 is to So 1:5:3. In that ratio, you have to allow. Other assets, there is no impairment clause because it considered inventory and good inventory and receivables, right? Okay. So this is what impairment.